Today you're going to hear 5 investing wisdom to help you become a better investor. And it starts with this. The first, be super patient. Nowadays, when we plant seeds on the ground, we expect trees, correct? The new generation has no time to waste. They expect trees to grow overnight. But the truth is, trees takes years to grow. And many a times when we plant, sometimes the seedling dies. Maybe there's suddenly very dry weather, the water is gone, the soil has turned bad, etc, etc. 1,000 reasons for a tree to not grow or for an investment to not do well. And even if the seedling starts to sprout out, sometimes it gets trampled upon. There is no certainty that it will definitely grow into a tree. So why do we invest? Because all it takes is some of your seeds planted today to grow into big trees that can give enough shade and fruits for the rest of your life. That is why we invest. And maybe to that point, I have a personal story to share. In 2023, I sold away my HDB flat. And the cash proceeds that came in, I've invested into REITs. Fast forward 1 year plus later, REITs have yet to resume back on a bull leg. And I'm still waiting patiently. Warren Buffett has this saying, the stock market is designed to transfer money from the active to the patient. This emphasizes the importance of patience in investing, and active traders too often react to market fluctuations or recession news. The patient investor, on the other hand, sticks to the investment strategy and benefits long term. Another quote by Jack Bogle, time is your friend, impulse is your enemy. This really stresses on that long-term investing strategies benefit over time and help you compound your wealth. That is why if you buy any investments today, be super patient that it may not work out for the next few weeks or next few months. It just needs time to grow. Investing wisdom number 2. Investing is simple but not easy. Let's take an example of losing weight. What is simple is knowing that you need to exercise, correct? That burns your calories. We all know about it. What is easy is to exercise one time. But what is difficult is to exercise every day and consistently. That is why something being simple may not always be easy. Let's flip this to investing. Many a times I see on discussions, oh, this ETF is cheaper than the other one by 0.04% over a year. That is factually correct and a simple interpretation. But what's not easy is to determine if the assets in this ETF actually is good value enough for you to buy. When we make any investments, there is a valuation process, correct? And that in itself requires research, assumptions, and forecasting. All these again are not easy to do and it takes years and years of practice. Philip Fisher has this quote, the stock market is filled with individuals who know the price of everything but know the value of nothing. Fisher highlights the difference between price and value. For us as investors, let's always focus on the value because what Mr. Market priced today may sometimes be unrealistically high or a bargain cheap low. Investing wisdom number 3. Markets are always volatile. Have you heard of these advertisement quotes? Do you know that markets are volatile these days, therefore use my trading system? Or do you know that markets are volatile these days, so you should join my investment course? Actually, the truth is markets have always been volatile. A news like that comes out, worst crash since 1987 and best day since 2008. These will always come about and suggest that volatility is never seen before. But the reason these headlines come is because as an index gets bigger over time, a 10% drop will look bigger. When the index is 10,000 points, 10% drop means 1,000. When the index is 40,000, 10% drop means 4,000. And these daily swings will just keep making new and new records, like in the Olympics. That is why expect to see a bigger crash than ever before and always respect that markets are volatile. The worst thing is to invest when you feel that the market is safe. As you look over here, there are periods where markets don't swing too badly, especially on the downward side. But every 6 to 12 months, you will hit a downturn. That is typically a correction. And in every 5 to 10 years, there is a major bear market. I pointed the corrections in red and pointed the bear markets in green. These are times to invest because this is where money is made in the buying. Even a very diversified stock, such as Berkshire Hathaway, managed by Warren Buffett, you would see that there's volatility of more than 20% in many periods. So when it swings down, do you need to trigger a stop loss? Not necessarily. Benjamin Graham has this saying, the investor's chief problem and even his worst enemy is likely to be himself. Graham points out that emotional decisions and lack of discipline are major hurdles for investors. Self-awareness and control are crucial to successful investing. That is why also I advocate a lot of dollar cost averaging to take away the emotions and be very disciplined in plowing money to the markets up or down. Peter Lynch has this saying, the key to making money in stocks is not to get scared out of them. He highlights that fear can lead to premature selling, which typically undermines long-term gains. Investing wisdom number 4. You are not alone getting hurt on a bad stock. You know, Mr. Market humbles all of us. Myself, some of my worst losses right now are Straits Trading and MPACT. Even Warren Buffett, the great investor, has recently admitted that he's 100% responsible for Berkshire Hathaway's bad bet on Paramount. They have invested $2.7 billion and lost more than half of it. As you can see over here, Paramount share price has came down and never recovered. That is why, to hope that you will never lose money when you make any stock investment is unrealistic. Even the best of us have made bad picks. But the question again is, why would someone make such a bad bet? There are a few reasons. Firstly, when we make a forecast, it can be wrong. There are assumptions inside that could change with time. So the solution is to not dwell too long on losses and not double down blindly. On the other hand, some who have lost in stock investing have become too risk averse and instead just choose doing fixed deposit, settle for 3% over 1 year instead of investing whereby some would lose and some would gain. That makes it difficult for you to build wealth for retirement. Hopefully this part on You Are Not Alone really helps you, and as always, smash the subscribe button, join our journey to 60,000 subscribers, and that's where you get notified when I release good investment content like this. With that, let's move on to the 5th investment wisdom for today, which is you can't be too sure of the market direction. Let me start by sharing with you a personal story. Back in 2011, I made a big swing betting on gold against US dollar on the FX market. That big swing netted me a very big amount. Then what do? Of course, I started to look for my next big trade, correct? And what I saw back then on markets was that US had a debt downgrade, the economy was starting to look shaky, and the stock market had rallied for 2-3 years already and looked mature. So through CFDs, I placed a bet that Dow Jones Index would head downwards. As time moved on, I increased the bet further and further until a point where the position got so big. In short periods, Dow Jones actually corrected. But overall, the index was very resilient and started to climb. That's where I actually cut losses and got this very important lesson on not being too sure on the market direction. Peter Lynch himself has said that it's not important to know. Warren Buffett himself has mentioned many times that market timing does not work. So again, do not go risk on, risk off fully approach. Oh, I'm going to sell all my stocks now because I hear that there's going to be a recession next year. Don't ever be too sure. Just now we mentioned about Berkshire Hathaway's volatility, whereby some periods it was minus 20%. But if we look in terms of the long-term chart, you would realize that it compounds upwards, correct? Suddenly all the minus 20% cannot be seen in this graph already. And that's actually how long-term wealth is built. If you agree on the message, smash the like button. And check out this previous video I have, how dividend investing can help you get to financial freedom. If you haven't seen it, check it out and I'll see you there too. Take care as always. Goodbye.